Well, good afternoon, everybody. Looks like we're right at the noon hour, at least here in Central Time. So we'll go ahead and kick off with some housekeeping items as we've got additional people joining us. My name is Karen Sanchez. I'm a partner in the Sikich's Naperville office. I head up our employee benefits plan services area, spending most of my time in the audit area, but also on retirement plan and welfare plan compliance issues. In my work, we are often the recipient of a lot of questions that come up after mergers and acquisitions have occurred. So I'm excited to hear our presenters today provide some solutions for many of those issues that we hear come up in real life when we're going through some of the audit scenarios. The topic of the webinar actually came up fall of 2019, pre-COVID. As many of you may know, we historically do a year-end planning webinar, which many of our clients look forward to each year, where we talk about payroll reporting items for the year. We included a small section on mergers and acquisitions in there, and the feedback was overwhelming that participants wanted to have a deeper dive into that topic. We'd originally planned on doing it in 2020, but we all know how 2020 went. We spent our webinar days trying to navigate all the quick changes in the law that was occurring and helping clients navigate those waters. So I'm excited to be able to present today the mergers and acquisitions in payroll and benefits topic, and we'll get to that shortly with introductions of today's speakers. Before I do that, wanted to just again encourage attendees to submit questions in the chat feature on the box. Our marketing friends will be coordinating those and getting those over to the presenters as we go through the presentation. We'll probably flag those for the end, as sometimes those topics are covered throughout the presentation. We want to make sure that we can get through all the content that we have today. Again, the handouts are located on the toolbar on the right-hand side. You can feel free to download those. In addition, after the webinar, our marketing team will be emailing those out to attendees, as well as a recording of today's presentation. We will be offering CPE for the CPAs out there, or HRCI and RCH credits for those who need those. In order to receive those credits, all the polling questions that we go through today that pop up throughout the webinar will need to be answered. And we also need you to complete a survey evaluation at the end as a pre-qualifier to get those CPE credits issued. Those certificates will usually be emailed to you in about 2 to 3 weeks time to get those out to you. In addition to just the requirement for those that need CPE, certainly we need those surveys, but we also appreciate the feedback so that we can present to you content that's meaningful to you and make sure that we are meeting those needs and developing webinars of interest to you and presenting them at the appropriate time and meeting your needs as well for that. So happy to have today the speakers. Sarah Truman is a certified payroll professional. She's a senior payroll consultant. She's got over 24 years experience in both domestic and global payroll services. I think, Sarah, if you want to advance to the intro photo screen, we can do that. She's got concentrated expertise in a number of specialties, including transformation projects, payroll automation, equity and bonus programs. She also helps clients with payroll implementation and optimization, SOX control evaluation, software evaluations and recommendations, opportunities for procedure development. In addition to that domestic and global experience, she also has industry experience in a whole variety of areas. It's probably easier to say which one she doesn't have experience in, as it's both public and private settings and manufacturing, healthcare, law, higher ed, defense, contracting, agriculture, engineering, forestry, and even more. She's helped clients in more than 15 countries. She's knowledgeable in a lot of payroll systems, some of which I've never heard of, but ADP's Vantage, EB5, Pro Business, Workday, Allegro, Safeguard, as well as many others. So she brings a wealth of knowledge from the payroll side of the house. Also pleased to have with us Todd Cleary. He's an attorney, but don't hold that against him. He's a shareholder with Godfrey and Conn's Employee Benefits team. He works out of their Madison and Milwaukee offices. He works with retirement plans such as the 401k, 403b pension, and ESOP plans. He also works with health and welfare plans, has done a lot of presentations on the Affordable Care Act and other benefits-related topics. And a significant portion of his practice involves handling the benefit aspects of mergers and acquisitions including the purchase agreement preparation, the due diligence, and the transition planning. So he, as well with Sarah, are going to be a great resource to help us through the questions that we have today. So with that, I will turn it over to Sarah to kick us off.
Perfect. Thank you so much for that overview. For today's agenda, we are going to start out with an overview of types of acquisitions and mergers and transactions. We'll move into some due diligence background items, change management implications, employee and payroll considerations, retirement plan issues, transition, and then suggestions and a time for questions. Although we will be talking about due diligence and change management, these directly feed into payroll and benefits, so that's why we will include those. So there are three main types of acquisitions or mergers. The first is horizontal. They tend to be same industry, same business stage. Economies, they're done for reasons of economies of scale, to reduce costs, expand offerings, and reduce competition. A really good example of this is the integration of Facebook, WhatsApp, Instagram, and Messenger. Combined, their ability to offer additional services to the consumer has vastly grown. The next is the vertical. Those tend to be same industry and early or late stage of a business process. An example here is Time Warner, which is a cable company. Their acquisition of Turner Corporation, which was a major media, and then several years later there was the Time Warner and AT&T merger. Very often you will see antitrust investigations in the vertical part. And the next is conglomerate. These tend to be unrelated industries. They're done to reduce risk and diversify. A good example here is Amazon's acquisition of Whole Foods. So let's switch to our next slide. And these would, let's see, these would then result, I think we missed a, here we go. Sorry about that. So then we have our transaction types. Here we have two primary types, which is the asset purchase. The seller remains as the legal owner of the entity. The buyer purchases individual assets such as equipment, licenses, what's called goodwill. And we have stock purchase, which is the purchase of the company selling stock only. And this then results in three different types of structures. The first is, complete assimilation. This would be, if Office Depot and Staples merged and it became one or the other. For example, we have a partial blend. As an example, I used to work for the parent company of Strayer University and Capella University. These were merged, but the two universities still stood on their own, where the back office and the administration type tasks were all merged. And then we have a standalone, which, a company acquires another and they're left to completely and independently operate. So as we start with our due diligence, these are items from both a payroll and a benefits perspective that additional information should be included in the due diligence. To do this properly, it will help you set up your systems for when the go live date is. So one of the first things you want to look at is what kind of grandfathered employee plans are there. Pay, union benefits. If they're bringing in the grandfathered benefits plan, do they need to have a benefits house bid to administer the plans? What's that cost? And all of these types of things should be negotiated in a transition service agreement. The more specific this is, the easier it will help you set up for success. And you also need to understand the commitments made to the organization acquired. Be looking for compliance and red flags in compliance. I worked for a company that did a merger and they were unaware that the company was not compliant in many of their tax filings, and that really came back to bite them. They had a lot of penalties and fees and interest associated with this. And you want to focus on compensation. Review executive comp packages. There's a lot of very unique items in executive comp packages, and you need to be able to understand those and what those mean. Look at base pay, types of incentives, additional items. And it's also a good time to start looking across the pay structure and job descriptions. Also, a lot of focus is on talent. What is the existing and future depths? Succession planning with mergers and acquisitions. There's often a large turnover, so this is really key to look at, even within your own payroll and benefit teams. Start with the executives, look at are the right folks performing the right jobs? Is it the right fit? What kind of commitments have been made? This can impact longevity. So if somebody's been promised a promotion after so long, or education training, and that's not followed through with, you're going to lose those folks. You can look at your diversity, and it's also a good idea to start aligning your pay grades. I put expat agreements under talent. This is very key. Expat agreements can be so specific and so different. You need to have a very good understanding of what those consist of. Are folks tax equalized? Are they given access to accountants? Are they given types of allowances? What do those look like? Do you need to do shadow payrolls? So we can get into that a little bit more later. It's key to understand if there's any union organizing going on, as well as to perform a culture assessment and an integration of the culture. All of these items will feed into the change management plan. And also need to document any side agreements. So with this, I believe we are now on to our first poll question.
Thanks, Sarah. So hopefully everyone has up on their screen the first poll question. I'll walk you through that. So if is your company currently involved in any M&A activity? Please select if any of these apply. So within 6 months, within the year, you recently completed it, congratulations to you. We're currently in process, sorry to hear that, or unsure or not applicable. So we'll give folks a minute to respond in one of those categories. You know, we certainly have seen an uptick in the M&A activity. We've got the group that handles that, and we just hear how busy they are in recent times. So we are, with the Sikich side of things, we're definitely seeing an uptick in activity currently. Okay, so survey says the majority of folks, 62%, are not sure or it's not applicable to their organization. 6% have something on the horizon in 6 months, 13% within the year, 10% recently completed, and 9% of you are currently in the thick of things in process. So thanks for your comments on that, and we'll take it back to Sarah.
Perfect. Thank you. So as we begin to think about change management, it's very important to understand that both sides should be open to processes or solutions of the parent or acquired company. Both companies have pros and cons to how they do things, and we do not, for the best outcome, it's best to not have a closed mind on this. So ask questions, understand, why do you do that? Why didn't you do it this way before you just make a unilateral decision? Change is very difficult for folks going through acquisition or merger. So anything you can do to make it easier is preferred. Something to think about is to have an on-site resource. If this is a global acquisition, perhaps have somebody in country. They can help to document the current processes and procedures, discover what is your population like, maybe hold some meetings to get some feedback. The important thing is that employees want to feel heard and seen and understood. So anything we can do to alleviate some of those concerns, and as a recommendation, is to leave an on-site resource through the acquisition and the first payroll. And maybe that means having somebody from your payroll team there on payday or a day after, those kinds of things to answer questions. Tend to see a lot of questions on those first payrolls. Also really want to understand communications, get controls around the communications. You want to dispel any rumors and make sure that truth is king here. And it's a good idea to create maybe a matrix or an FAQ of what is changing versus what is staying the same. And although they may be doing this about some, the business side, employees really care about their payroll and benefits. So this is really where they're going to study and where you're going to get a lot of questions. Any background work or upfront work you can do on this to put out there in their hands will alleviate a flood of tickets, or if you have an email system, calls, what have you. This is very, very important to get ahead of. Excuse me. Also want to make sure that the accountability is defined and known, both for the acquiring firm and the existing firm. Things are compensation, technology, payroll, expenses. How do they ask questions? Who answers the questions? If it needs to be escalated, what's the escalation path? As well as then decide what is the process for information dissemination. How are you going to reach these? Are you going to do newsletters? Are you going to put it on your intranet and make sure everybody understands? Sometimes if they're getting emails, people can start to ignore the emails after a while. It's a good idea to have multiple methods for information dissemination. And a little bit, we need to touch on branding. Are you going to have two different benefits plans? Are you going to have two different pay state or earning statements from payroll? Are you going to merge systems? Do you want them all to be aligned and look the same for everybody? These are things to think through and decisions to be made. Next, it's a very good idea to have some type of playbook or checklist. So while the merger acquisition as a whole needs a playbook, and in fact, it probably is one, so do each department. So payroll needs a checklist, benefits needs a checklist, AP needs a checklist, etc. And maintain this in a spreadsheet with due dates, with specific deliverables, and assign a person to take that deliverable. I don't know, the payroll world, we use year-end checklists and do these types of things. Same idea here. And want to make sure you're holding status meetings both within your payroll or benefits team, as well as a representative from that team on a larger scale with additional folks higher up in the organization. So everybody is on the same page. We understand any problems, something we didn't know that came up, etc. And then you can track and go back. I've been involved in a number of M&As, and when 6 months later, a year later, there's a question on, well, what was done here, what was done there, you can go back and look at the spreadsheet, find the notes, those types of things. As well as you need to think through what type of training program you're going to have for your employees. Many are going to be trained on new timekeeping systems, absence, expense systems, new HR payroll and expense contacts, different escalation paths. So are you going to do videos, where those videos are going to be posted? Are you going to have emails? Are you going to have reference guides out there for people to understand and maybe have somebody sample use them? That way they can find any gaps. Sometimes when it's your system and you create the video or the guide, you miss something just because it's automatically known to you, or other folks can spot holes for you. I also believe it's a good idea to put out a sample earning statements with explanations. Many times, if you're changing payroll systems, the codes or the descriptions are different than what people are used to seeing. If you can get a sample statement out there, then folks can say, oh, well, my shift differential was called this in the old system, but it's called a premium here. Yes, I can see the money is the same, and that type of thing. Any tools like this you can get out to your customer, they would be, it's going to save on time and questions on the back end. Also think through the intranet. What is the intranet going to look like? Or is there going to be one? Is there going to be two? Do you need to train on the intranet? And make sure folks know where to go on the intranet to find the answers they look for. So you may have a new one, but I don't know, have a mapping or some kind of directions that you give people so they can find their information on the intranet itself. So once you get to the final stages, you want to make sure there's no surprises. Again, come up with as many FAQs, make it an iterative process so they're being updated or expanded upon as you go. And a warning, I guess, you know, I have a colleague who went through an M&A, and the acquired company, the CEO of the acquired company got up and told everybody nothing's going to change. Well, that's simply not true. So kind of control those types of things, make sure everybody knows change is coming. We let you know what it looks like as it comes. And remember that culture matters. I worked for a place that, you know, if they brought on a new timekeeping system and just kind of everybody just figured it out, then they had an acquisition and expected that acquisition or acquired company to do the same, and nobody could understand how to use the new timekeeping system. They were very much expecting videos because that's what their previous company did. Any type of change was done with a video series, step-by-steps, and they just were not used to figuring things out on their own. So culture matters as we go through this. Other items to look at are your systems. What are the impact of people and processes? What's that going to look like? I highly suggest performing some type of process mapping. What feeds the payroll system? How is it fed? What are the timing of those? Is there other information that needs to happen? What are the downstream impacts of the system? And many times this is not discovered until you do process mapping. It also sets you up if you need to do any kind of upgrade or new system implementation in the future. You know, I've worked for places where they doubled overnight, so current processes had to be changed in the future, and the process mapping is really the basis for setting you up for success in the future. This leads into, you know, software decisions. Are you going to have two standalone systems? Are you going to have a new system? Are you going to have one system and bring everybody into that system? It's time to start having those conversations and think through what that looks like. If a new system is warranted, this will also help build your business case for that. Can the existing systems handle commitment? So for payroll, you know, you have your earnings and deductions, but maybe the acquired company has several types of payroll items that your current system is unable to process. So you need to review and study that so you can set it up in the future to be successful. It's also a good idea at this point to start to involve your PMO office if you have one. Just work very closely with them. Oftentimes, I don't know, sometimes PMs, you know, they have a schedule, they have a date, and they set up arbitrary dates that can result in punitive results. So if you have them work in conjunction with your payroll and your benefits team and setting those dates, you're going to have a better experience. And remember to follow your instincts. If something doesn't feel right, it probably isn't. So dig into it. If you just kind of have that thing bugging you and you leave it, it's going to come and bite you later on. So again, this comes back to your due diligence. Also the employee treatment. Remember, these employees are going to be at a new company. They may have to go through the new hire process with a full onboarding. So you're going to want to think through this. How can you give them the best experience? You most likely will be keeping their previous service dates. So make sure your system, even though it has a date of hire of, you know, today, if their service date is 5 years ago, you're going to have to review that type of things. It's this is where you can start to align your pay periods and pay dates, as well as your employee handbook. And sometimes the two companies would operate separately for the handbook because the handbook takes a while to go through, review, update policies. Maybe your legal team needs to look at it. The old company should be facilitating severance, the buyouts, and the PTO buyouts. Again, this should be spelled out in your transition services agreement. From a systems perspective, it is probably best viewed as an implementation instead of converting data. So maybe they have some pay components or some information in the old system. It's not simply a data move into the new system. You need to look at the old system, what was there, what was needed to pay or for the business or for reporting, and how can the system the employees are being moved into handle those types of needs. And maybe you need to do some further development and those types of things. So to just keep that implementation mindset. And also make sure the data is loaded correctly. As with any implementation, you load the data, you validate the data, you revalidate the data, etc. And I always say it's a good idea to then, in the case of payroll, send out the task once you're ready to go to have employees log in and revalidate their address and their locations and their banking, etc. That way you can be sure your data is correct, which would result in less errors downstream. At this time, you're probably also going to see some fatigue among your staff. They've been, working these projects for a while. Systems maybe aren't up to handling what they need to. There's a lot of change going on, and you can have a high burnout rate. So be aware of this. Although it's a busy time, everybody's got deadlines, make sure folks can take a day off, vacation, check in with them, see how they're doing. Those types of things. All right, so now we move into the tax component, which is a really big impact on payroll. If it's a complete restructure, you may be looking at a new FEIN. I suggest a company mapping document. Every job I've had in the last, 15 or 20 years, I've had a map of the companies on my wall, and that's been very helpful. So if you can get one of those, that's great. Were there name changes? Remember, with all of these changes going on, you may need to open up new SUI or state withholding accounts for the new companies, new locations, set them up in your payroll system. They may show as an applied for status, but make sure you close those out by the end of the quarter to avoid penalties and interest. Make sure your TPA assignments have also transferred. I worked for a company where, we were told that all the TPA assignments transferred, and they did not. And it took a while for these to find out. We were getting rejections in our tax filings. It took time to find out, okay, this was filed timely, but by the time we researched to find out the rejection reason, what happened, and to correct the TPA and file again, we missed the deadlines. And so they were impacted with penalty and interest, several $100,000. Some of it reached the millions. So this was a big problem just for a simple TPA assignment. Also, make sure you are, the old company is filing any, marked last return if that's really what's going on. So follow that through, and I would encourage to have a specific checklist just related to taxes on its own. When you're finished, as the companies merge and move forward, you may need to have access to historical account information. So I worked for a company that Ceridian handled the old taxes, ADP handled the current company and the new taxes moving forward, but we very much needed access to that historical account information. This was also the company that was not compliant with their tax filing, so we had to develop a very close working relationship with the previous tax filing agency to be able to research and handle that and what went on. So think through that. And the other part of the tax component that needs to be thought through is lock-in letters. You may have some employees that have lock-in letters. Make sure those are moved to the new company. Global employees. So global employees have kind of their own considerations that apply to them. As I mentioned previously, you really want to dive in and understand the expat agreements and PATs. What kind of tax equalization is going on? Are they completely tax equalized, only partially? What are their allowances? Are their tuition allowances, cost of living? If their tuition allowances, are those imputed monthly? Are they imputed all at the end of the year? I worked for a company who would give this once a year and then tax them in December on that. And some of it was like $40,000 or $50,000, and then they got hit with the taxes all at Christmas. Well, people didn't really appreciate that, right? So we started doing this on a monthly basis instead, and it gave a tax break on the tuition. Kind of cost of living are out there. Are your what shadow payrolls do you need? Are your shadow payrolls compliant? Do you need to open up into new countries? Do you need to look at some new global payroll providers? Do you need to have some in-country payroll providers? Those types of things, and really review your visas. This is in direct relation to a student worker. Do you have access to their visa expiration date? When are they going to no longer be eligible for the student exemption? These types of things. And another thing I encourage to look at is your HCM system hold proper requirements. So in Germany or Japan, employees have to provide certain information. I'm going to call it pension or retirement or social insurance information, their account numbers, their, what level, what's their deferral, these types of things. You need to be able to hold that somewhere. And can your current systems handle that? These are really good things to think through. Payroll decisions. So we kind of touched on this a little bit. Pay earned. When is payday? Do you need to align your pay cycles? Do you need to have a short pay cycle? I worked for I worked for Booz Allen Hamilton for a long time, and when they did acquisitions all the time, but they just brought them in as a new hire. However, and they onboarded through like a regular new hire would. However, if the pay cycles were off, they would frequently give them a signing bonus, a couple $1,000s or whatever. But what it was meant to do was to bridge the gap from the previous pay cycle to align with the current pay cycle, so they didn't struggle. So maybe it's as simple as that, and maybe that's easier than doing a short pay cycle and running extra payrolls. It really depends on your business, and think through the frequency. Is the work week changing? Maybe the parent company has a work week of Monday through Sunday, but the acquired company has a Sunday through Saturday. There will be some overtime implications there, and employees need to understand that. Who pays the pay? So if the companies go live together on 1/1, well, you have, I'm going to say semi-monthly, at 12/16 to 12/31 payroll. Is the old company going to pay that on January? In January, is the new company going to pay that? And the old company going to be responsible for paying the new company? What is that going to look like? And again, ensure your agreements are specific, and this is outlined in the transition services agreement. There's going to be special employee agreements, special pays. Who pays the taxes? Does the old company? Does the new company? Are they grossed up? If they're grossed up, again, who pays the taxes? And as folks get RIF'd and leave employment, there is a difference in severance between a lump sum severance payment and salary continuation. Lump sum is taxed at a supplemental rate, where salary continuation can be taxed at the regular rate of pay. Make sure employees understand that. Make sure your system can handle both types of taxation. As we move into the payroll processing, review your earning and deduction code setup. So we touched on this previously as well. Do you need to set up new codes in your new system? Do you do that with your payroll provider? Work with your accounting team. You need to map the GL mapping and the new accounts. And this is also a good time to actually review the new codes. Simply do not do a lift and shift of, well, this was what the old code was set up in the old system, and this is how we have to have it in the new system. Maybe they weren't compliant. Maybe they were running things through that code that they shouldn't have been. So take this opportunity to do a deep dive into that. For your time and absence systems, are you assimilating everybody into one system? Are there standalone systems? Look at the special pay rules for shift or roles on call. Do you need to set up these new types of ways to gather this information in your current time system? In conjunction with your comp team, look through one-time payments and allowances. This is a very good opportunity to align your policies and dollar amounts, and also identify your files. What are your sources for your files? One place I worked for, we found out the last week of December that there was, a wellness file out there where people were getting cash bonuses through the year, as well as an executive parking that had never been run through payroll. We had to load that. There was no paydays left for the tax implications, so we, carried the tax implications over to the next year. But we ran it and was able to get it on the W-2, and that was not easy to set that up at the last minute and do the GL mapping at the end of the year with everything else going on. So, talk to your benefits team, talk to the wellness team, talk to everybody you can think of out there for any kind of file you can think of. Do you have this? How is it received? When is it received? What's the format? Do I need additional information for my system to be able to process based on the other system? These types of things, and as well as to gain an understanding of the types of programs. In theory, this should be collected in your due diligence, but we know that things are always missed. So it's a good idea to add this to your payroll checklist. There can be some pretty big garnishment implications. So if the old company is disbanding and they're moving them to a new FEIN, termination letters need to be sent to those folks, as well as a notification of change of employer. You do need new garnishments if the FEIN changes. So work through that. But is the old company going to send these out? Is the new company, what is that going to look like? The Child Support Enforcement Division, communicate with the agency. Pay date schedules may change. So this was not an acquisition, but again, I worked for Booz Allen Hamilton, and we moved from one payroll system to the other. They pay on a monthly basis, the last day of the month. Garnishments and child support was funded by the company on the last day of the month. Well, we moved to ADP handling this, and I think ADP defaults to payday plus 5 or something like that. So what ended up happening is garnishments were paid on December 31st, but then they were not paid again until the first week of February. Many people there have clearances. Well, then it started showing up that child support was missed for the month of January. What happened? What was missed? I had many phone calls with agencies, ex-spouses, all you can think of, and we were paying these as fast as we could with, checks, wires, my American Express, whatever we could do. But if we'd simply communicated with the child support division ahead of time, it would not have had as many downstream impacts, and it was a miss nobody thought of. We ended up changing it to payday plus 0 days to get us back in alignment. That was had some pretty serious ramifications. As well as if you're just absorbing them into the new system and the FEIN is moving over, make sure you transfer your goals for your garnishments, and don't forget that. Let's see. And for payroll implications for benefits, you're going to want to talk through with your benefits team the alignment of plan benefits, including accruals. What did the old accruals look like? What did the new accruals look like? Are we going to have 2 sets of accruals? Are we going to have one new accrual for everybody moving forward? And it's helpful for payroll to have a seat at the table here. Many times these plans are great and fine, but when it comes time to programming them, they're not very easy. So if payroll can get in on those and say, hey, the system can only be programmed this way, it's gonna help you alleviate stress down the road. Maybe folks need to be enrolling in new plans. It's important to understand the timing of the outbound and inbound files and how that will impact your payroll. I worked for some place where they did an outbound once a month, and they were totally not in compliant with 401k. Those should have been done every payroll, and so there was a lot of questions that happened there. Maybe there's profit sharing. Who's responsible for the profit sharing? If the profit share ended on 12/31, but it's paid in May. Who's going to pay that? Is it still going to be paid? Are the employees going to get a bonus? These types of things, as well as which company is responsible for the 401k match on the first payroll, if the first payroll is for the previous company in the previous year. Make sure you have a very good understanding of your equity plans. What kind of stock options do you have? RSUs, RSAs? Is your system able to tax appropriately? As well as if this is a mid-year transition, to remember to bring over your prior balances for your FSA, HSA, 401k, etc. So I will, let's see, I think we have a poll question now.
Thanks, Sarah. So our next question is, are payroll and benefits involved in pre-close tasks? Yes or no, or unsure? Hopefully everybody says yes, but my gut feel is there might be a number of no's. I know on our end, we hear a lot of questions after the fact. So I suspect we're going to see some no's in here, but I'm hoping for yeses. Yes is almost always a funner answer to receive. Give everybody a minute to respond. Yay, so we got 77% yes, so there's a lot of people doing it right out there. 6% said no, and 17% it was either not applicable or unsure. So thank you for your feedback on that.
Thank you. At this time, I will hand the baton over to Todd. And Todd, do you want to start your discussion on benefits?
Sure. Good afternoon, everyone. Notwithstanding the results of that prior poll question, my experience is that the benefits issues often are viewed as secondary in the grand scheme of the deal. So they do frequently get pushed back to the end, and that, you know, that delay can create some significant issues. Benefits issues, you know, liability associated with benefits plans can be significant, and how they are handled can have a major impact on employees. Waiting too long to deal with them in the deal can reduce the flexibility of the buyer. For example, if there are problems that are detected earlier in the deal, the buyer can, it has, you know, a handful of options. It can make the seller correct them prior to closing. It can correct them itself after closing, but have the seller pay the costs. If the issue is significant enough, it could even result in a purchase price adjustment. As an example, we're working on a transaction right now. We discovered, we're representing the buyer, we discovered that the seller has not filed certain annual reports that are required for benefit plans. And because we detected the issue early on in the deal, the seller has filed the reports itself under a Department of Labor program. The issue should be, you know, everything should be shipshape, and we can cross that issue off our list in terms of due diligence concerns. So that's kind of an illustration of why you want to detect these issues early. Also, if there's too much waiting and the benefits issues are delayed, that can also reduce flexibility in terms of transition structuring, and I'll talk at more length about that here in a few minutes. So it is important to start looking at and thinking about these issues early on in the deal process. So first slide, significant due diligence concerns. These are, back to the next slide, Sarah, my apologies. These are major diligence concerns. Obviously, this is not an exhaustive list, but when I go into a deal, these are probably, depending upon the type of deal, the 4 issues that I'm most concerned with and gonna wanna get answers from the seller For that matter, even if we're representing the seller rather than the buyer, we're going to want to get in front of these issues as well. So I would be asking these of the seller as well. So underfunded pension plan. This is just the old traditional pension plans where participants may get a monthly benefit after retirement. We don't see as many of those anymore, but to the extent they still exist, they can have significant liabilities associated with them. These are also considered to be controlled group liabilities. Under benefits law, entities that are sufficiently related by ownership are essentially treated as a single employer. They are referred to as controlled group members. And if you have a controlled group, then entity A can be liable for issues associated with entity B's benefit plans, even if the employees of entity A never participated in that plan. And that can be a real surprise for parties in a transaction. They can have difficulty getting their mind around that law. It is a bit of a head scratcher, but there's a long historical reason why the law is set up in that way. So, and because these liabilities can be so significant, this is an issue that both parties would want to be looking at early on in the deal. Multi-employer plan withdrawal liability. This is also a controlled group liability. So again, if you have two control group members and only one of which is contributing to a multi-employer pension plan, that can still generate liability, significant liability on the second employer. So what is withdrawal liability? This can apply when an employer has a union and it contributes to a so-called multi-employer plan, which is administered by a joint board of trustees, and it makes pension plan contributions on behalf of its employees. And if the employer withdraws from the plan, for example, goes out of business or the collective bargaining agreement expires, then withdrawal liability can be triggered. And that is essentially the employer's portion of the unfunded vested benefits of the plan. And because these plans have had so much trouble historically, it is not uncommon for even a small employer with, say, 50 employees to have seven-figure withdrawal liability. So, this can be significant. Another concern in terms of getting in front of the issues are that employers that contribute to a multi-employer plan can request withdrawal liability estimates from the plan, and those can take some time to get. So, and given that potential withdrawal liability is likely to be a significant issue in the deal, you don't want the deal to be delayed. You're going to want to get those withdrawal liability estimates as soon as possible. Qualified retirement plan compliance. So qualified retirement plan, an example, the most common example is a 401k plan, but it also is the pension plans that I mentioned, employee stock ownership plans. Those are all types of qualified retirement plans, and they are all subject to very complex requirements under the Internal Revenue Code. And if the plan does not comply with those rules, the IRS can come in and impose very sizable penalties or even disqualify the plan, which means that the plan's tax benefits are lost. And the IRS has this plan correction program under which employers can go in and fix certain plan errors. And it's generally a pretty reasonable and navigable program. And because the IRS has this, it takes a harder stance when it finds noncompliance on its own. So as a result, it's far better in most cases to find those errors yourself and clean them up before the IRS finds them. And that's why it's important to do the due diligence on these plans early on. And as I will discuss here in a minute, this can also be a transition rule concern as well. And finally, on the diligence concerns, Affordable Care Act mandates and reporting. So this is the employer mandate, which requires employers of a certain size to provide satisfactory health plan coverage to full-time employees or run the risk of paying penalties. These laws have now been in place, or this requirement has now been in place for 6 or 7 years. The IRS is now starting to assess penalties. They can be very large, well into 6 figures. Frequently, I would say at least half of the time, those assessments have been wrong and can be explained away with relatively little effort. But you have a deadline to do that, and there's specific requirements that have to be followed. So that is something that if you're the buyer, you're going to want to get in front of. Sarah, can we move to the next slide, please? Retirement plan compensation issues. So this is something that can crop up late in a deal. Let's say, for example, the seller wants to reward its employees for the fact that the seller's getting a very handsome purchase price in this deal. Seller wants to pay bonuses to employees, essentially immediately prior to close or at close or right after close. Or let's say that the seller has entered into agreements with executives where it'll pay them a handsome bonus if the deal closes, because the executives frequently have to do a ton of work to get a deal done. And the issue here is whether these bonuses can and should be contributed to the 401k plan by employees, and if so, whether matching contributions on those employee contributions would be payable. And the answers to these questions are important because they can affect the numbers in the deal, the finances. And we unfortunately frequently see this. It gets delayed until the last minute, so there's a scramble to figure it out. If possible, it is ideal to get in front of the issue, check your plan document first or early to see if the bonuses are 401k plan compensation, and if so, whether whether employee deferral should be taken from them and whether they're entitled to a match. So get out in front of it early, check your plan document, or even better, have your benefits counsel take a look at it, because this is a really technical and complicated issue. Next slide, please. Guess we have a poll question at this point.
Thanks, Todd. So the next question is, what do you see as potential issues for your next current transaction? Do you have concerns with regard to Cobra, compliance, 401k plan benefits, change management and transition issues, or other not applicable? We probably should have added an all of the above too, but maybe pick your highest rated concern. Those of you in the midst of a transaction may want to mark them all. We'll see if this is consistent with what Todd hears on his end of things. Give everybody another minute here to respond. Okay, so Cobra came in at 11%, overall compliance at 23%, 401k plans 27%, change management transitions issues almost half at 48%, and the rest in 33%. So Todd, I'll let you take it from here.
Yeah, that's interesting. I guess that is pretty consistent with what I see. I think transition management issues tend to be the most important. Of that list, I would say Cobra is often the least important, although for reasons I'm going to describe here in a few minutes, I think the importance of Cobra is going to go up for the next 6 months. Transition issues. So the way I view this is the parties asking themselves, how do you want things to look after closing from a benefits perspective? And usually the most important issue is in terms of transition, what do we want to do with the targets for 401k plan? And the options and applicable considerations, of which there are many, tend to depend upon the type of the deal. And so equity transactions are usually significantly more complicated in terms of deciding how the buyer wants to handle that plan. And the genesis of the complication is a 401k plan rule, which says that distributions cannot be made if the employer maintains an alternative defined contribution plan. Well, for this purpose, the employer is defined on a controlled group basis. So if the buyer waits until after the deal has closed and it is buying the equity, all of the equity of an entity, those two entities are now likely going to be controlled group members. And if you are now after the deal and the buyer has another 401k plan in its empire, which is frequently the case, then the buyer will not be able to terminate the target's 401k plan. Instead, if the buyer wants to get rid of one of those two plans, which is very common, the buyer will have to merge the two plans, and the merger option creates other considerations, which I'll talk about here in a minute. But let's assume a parent buys a target and the target is going to be a wholly owned subsidiary after the transaction, and both have 401k plans. Well, maybe the parent wants to leave the target's 401k plan in place until the end of the year in which the deal closes, and then bring the plans together. Well, in that case, or I should say, and then have the target terminate its 401k plan. Well, that isn't going to be permissible due to that law, which I mentioned. Instead, the buyer would have to merge the two plans. So what are the options? In an equity transaction, the buyer could insist that the target terminate its plan prior to closing. The advantages of that approach are that if there are problems, compliance problems with the target's plan, those problems will not taint the buyer's plan. If instead there is a merger, any problems, non-compliance associated with the target's plan can jeopardize the entire qualification of the buyer's plan. So that's probably the biggest downside to the merger approach, and it's probably, and hence the biggest advantage to the termination approach. This fact that if you terminate the plan prior to close, they do not have to be merged. Another advantage of the pre-closing termination approach is that employees can get their money. Employees will all have the option of how they want their accounts handled. Do they want to receive a taxable distribution? Do they want to roll their account over to an IRA? Do they want to roll their account to the buyer's 401k plan, assuming that's permissible? Employees tend to like having that flexibility. And another advantage of this approach is that the buyer's plan does not have to carry over certain so-called protected benefits to its plan. There are certain features that must be carried over in a plan merger to the recipient plan, and those can be challenging from an administrative perspective. They can be a pain. Examples might be certain forms of distribution, the ability to take distributions over certain periods. For example, an in-service withdrawal may be a protected benefit that the buyer would have to carry over to its plan if it does a merger. If the If the buyer has the target terminate its plan prior to closing, you don't have to carry over that baggage. What are the cons of a pre-closing termination? The target will have to fully vest all employees, all participants, which may or may not be a big deal depending upon whether that plan has a vesting schedule. It could be that all contributions from the employer are already fully vested. The buyer, assuming it wants to offer 401k benefits to employees at closing, is going to need to have its plan in place such that employees can begin to participate immediately. That can be an administrative challenge. The termination approach can adversely affect any outstanding plan loans if the target's plan allows loans. It generally will make those loans due and payable by a certain deadline after closing. So that can be a real unwelcome piece of news to employees who have these loans. There may be the option to roll over outstanding loans from the plan which is terminating to the recipient plan, but that requires some coordination between the parties prior to closing and can be administratively challenging. And another negative associated with the pre-closing termination is that, while it's good for employees that they can choose how they want their accounts to be handled, it's more work for the buyer, or more accurately, it's record keeper to have to deal with all these rollovers now. The money doesn't just come automatically. It's an employee or participant by participant decision. So another option is, so the merger, the post-closing merger, the advantages and disadvantages of that are kind of the flip side of the pre-closing termination. If you're going to do a merger, you don't have to fully vest participants. There shouldn't be an adverse effect on loans. Whereas with the merger approach, as I mentioned, there's the risk of tainting the plan of the target's plan, tainting the buyer's plan, and you have to worry about the protected benefits. Another less frequently utilized option is to operate multiple plans. Maybe the buyer wants to have different benefits for different divisions or different benefits for different entities. That may be fine as long as it isn't discriminatory in favor of so-called highly compensated employees. So that will have to be vetted in advance to make sure that there isn't any discrimination problems. There is a transition rule after deals that applies until the end of the plan year following the year in which the deal closes, in which there can be relief available from these non-discrimination testing requirements, or at least relief as to the need to aggregate the two plans for testing purposes. And of course, if you're going to operate multiple plans, you're going to have administrative costs for two plans as opposed to one. On the asset transaction front, the rules are considerably easier because that merger requirement does not apply in this context. So the two options that we see most frequently are to have the buyer assume the seller's plan. For example, let's say you have a private equity buyer and it's setting up a new company to buy the assets of the seller. The new company doesn't have a plan of its own yet, so it would make more sense in that situation to have the new company assume the seller's plan. The advantages of that approach are it's considerably easier for employees. There's no impact on their loans. They don't have to make new deferral or investment elections because everything is staying the same. And there's no full vesting requirement, so that's an advantage to the employer. From the buyer's perspective, the biggest con with the assumption approach is the fact that it is now taking on liabilities associated with that plan, which it would not have those concerns if it's setting up a new plan. The buyer can take certain measures to protect itself in the purchase agreement via negotiation, but that's just an additional headache to have to deal with. On the new plan option, another consideration is just to make sure that that plan can be up and ready as of closing. Sometimes that can be difficult depending upon how quickly the deal comes together. Next slide, please. I see I'm running somewhat short on time. I think I'll move through these last slides pretty quickly. Cobra responsibilities. So the default rule under Cobra is that if the selling side has a plan after closing, then it has the Cobra responsibility. The parties can contract around that default rule, but in most situations, it doesn't make sense to do that. So for this purpose, we're really worried, or we're talking about people who were either on Cobra as of closing or eligible to elect it, and any employees and family members who are losing coverage as of closing due to the deal. Now, in an equity deal, people are remaining employed, so there usually aren't significant Cobra concerns in equity deals, but there often are on asset deals. The government is going to be paying 100% of Cobra subsidies for people who lose coverage due to reduction in hours and an involuntary termination, and that's going to be the case through September. So I think Cobra obligations, the Cobra responsibility is going to be even more of a hot potato now than it has been historically, because Cobra is normally viewed as a money loser for the employer, and it's going to be even more of a money loser now, given that Cobra coverage is going to be free for all these people, and particularly for self-funded plans who are, going to have to pay these claims up to stop loss coverage out of their own pocket. This is an unwelcome development. Whether to grant service credits, this is, viewed as a positive for employees. It's kind of a welcoming gesture. Employees may look at a transaction and say, we're going to continue to do the same job we did before, essentially, and we're going to have to, if you don't give us these service credits, we're going to have to start over from an eligibility perspective and a vesting perspective through no fault of our own. So often the buyer will grant service credits for eligibility and vesting purposes. Vesting is typically only a retirement plan concept. They may also grant it for retirement plan allocation purposes, which is when a plan has, let's say you have to be employed, you have to work 1,000 hours during a year to get the matching contribution for that year. And then the service credits are often granted for waiting period purposes. Although before the buyer does that, it's going to want to make sure that the insurance companies have agreed to do so. Next slide. And then another issue of an attempt to be welcoming is if you're the buyer, whether you want to grant credits for new employees toward their deductibles and their out-of-pocket maximums. If not, the employees could have to start at zero toward meeting their deductibles and out-of-pocket maxes, again, through no fault of their own. And again, if the buyer wants to do this, it should first consult with the insurance company or the stop loss carrier if the plan is self-funded. And it should also actually check with its third-party administrator if the plan is self-funded, because the third-party administrator is going to have to administer this and is going to need to make sure that it can accommodate the information from the selling side. Next slide. So as I described, due diligence issues on the benefit side can be financially significant and affect the deal. As a consequence, you're not going to want to leave those until the last minute, nor are you going to want to leave transition issues for the last minute. And most specifically, not acting on the 401k plan transition until after closing can essentially eliminate the option to have that plan terminated prior to closing. That's all I had.
Thanks, Todd. We've got a few minutes left here, so I wanted to see how many of the questions that we can get to. So I'll throw this out to both Sarah and Todd, if that's okay. One question we had, clarification on Sarah's presentation, was when you talked about under the review earnings and deduction code setup, talking about making the correct taxation apply to the new codes. Can you clarify what you meant by the no shift and lift? I think you're on mute still, Sarah. Okay, well, we can move on to up there, Sarah.
Okay, I was muted by the organizer and couldn't answer.
Oh, I'm sorry.
Yeah, so a lift and shift is simply, okay, this code for whatever, this earnings code is only taxed for FICA, not for federal, and you set it up in your new system the same way. This is where you need to be doing an evaluation and saying, what is really going through this code? How should it really be taxed? And these particular RSU earnings should be taxed one way and they're taxed the other. So you really need to look at what's running through those codes, what the taxation should be, and set it up in a compliant way in the new system. That's where I was going.
Great, thanks, Sarah. Another question, if the bonus is allowable to go towards the 401k plan, could that cause issues with respect to the maximum contribution amount as well?
It certainly could. Yes. Presumably, the questioner is asking about the annual limit on how much can go into a participant's account on an annual basis. I mean, yes, it could, but no different than any other matching contribution. But it would certainly be counted toward that limit, yes. And if there's a problem, it should be caught by whoever's doing the testing at the end of the year, and that can be corrected if need be.
That's a great point in coordinating all those things up front to set expectations and communications but don't promise that until you've reviewed all the rules. Next question, if the seller's plans are terminating, how are involuntary terminated employees enrolled in Cobra prior to acquisition to be transitioned? And is this a new enrollment opportunity for those members onto the Inquiring company's plans?
Could you repeat that question?
Sure, it was almost a two-parter. Yep. If the seller's plans are terminating, how do the involuntary terminated employees go onto Cobra prior to acquisition to be transitioned?
Well, it wouldn't occur prior to the acquisition. It would occur contemporaneous with closing, essentially, although the buyer's not going to be able to get its Cobra notices out until sometime after closing. But it would essentially be that the buyer would, I think the buyer would have to find out from those who are eligible for Cobra, you know, what option they want. Do they want to continue to have Cobra? And there are model notices available from the Department of Labor that, you know, I think could be used for that purpose, and in fact should be used for that purpose.
Okay, thank you.
Did I answer all the questions there?
The second part was, is this a new enrollment opportunity for those members onto the Inquiring company's plan? So I think that is kind of all encompassing with.
Yeah, I would view it as more of a, I mean, it's a new enrollment opportunity in that the buyer's plan didn't have any obligation toward this person until the transaction closed. But
okay, actually, just had a clarifying message come in. She says, he or she says, I mean, if the company members are eligible for ARPA before the close date, clarification on that question.
The individual's right to the subsidy would continue just, you know, as if there was no transaction. It would seem to me it would, if the person was eligible for the subsidy under the seller's plan, I think they'd be eligible for it under the buyer's plan, although I guess I'm not 100, I've never seen that question asked, but that would be my take.
Okay.
Yeah.
All right. How would one go about starting a checklist for this process? I know there was a lot of great content included today, but is there an initial starting place to create these sort of templates to build off from, or how do you go about starting a nice detailed schedule? Sarah had a great recommendation to have one, but how do you start building that out?
Think through. I would suggest start thinking through your through your processes. List, you know, think through your process step by step, and make a line item for each step, and then analyze each step and the components that make it up or what is needed, and write those down as well. It's going to be different for every company. So that's how I would tackle a start for a checklist. You know, work with the M&A team, see what they've done, see if they have one, you can expand on their line items, etc.
Great. I think we're running about to the end of our time here. So thank you, Sarah and Todd, for all the great information that you provided. Couple wrap-up comments again. As a reminder, all the attendees will receive a copy of the handouts and a recording shortly. You have all of our contact information if you think of some questions later as well. We'll also, again, in order to receive the CPE, we did need you to complete those polling questions, and you should receive those certificates in the mail in the next 2 to 3 weeks. We appreciate everybody attending today, and again, really look forward to your feedback in those surveys of what we can do to provide meaningful content to you going forward. So thanks for attending, and have a great day, everyone.